Hello and welcome everyone. My name is Viola Polakowska and I'm the Associate Director of Alumni Relations here at the Business School. It is a great pleasure to see so many alumni and students joining us for today's session. And I can see so many of you here already. I'm sure that you are joining us from across the globe. It would be great if you share with us in the chat the city from which you are joining. So just enter the city where you're currently located so we can see where you are currently based. Today's session, I'm really pleased to introduce on how banks innovate. And the session will be led by Professor Pinar Ozkan, Professor of Entrepreneurship and Innovation here at the Business School. And Professor Ozkan will be joined by our Executive MBA alumnus, Christer Holloman, who did his Executive MBA in 2014. And we also have a fantastic panel of experts who Pinar will introduce to you very shortly. We've got loads to cover, so I will hand over to Pinar without further ado. And I do hope that you will have a fabulous session. So over to you, Pinar. And I will see you all at the end of today's session. Have a great day.
Thank you so much, Viola. It's a pleasure to be here, and thank you so much to Christer and all our guest speakers to be here today with us. And I can see everyone joining from amazing places, like all the way from Lima, Peru to Johannesburg and Australia and Atlanta. It's wonderful to see you all here. As Viola has said, I'm Pinar. I'm a professor of entrepreneurship and innovation at Said Business School, University of Oxford, and I'm also the director of the new Oxford Future of Finance and Technology, or in short, Fintech initiative, where we do lots of research on fintech and in general how technology is impacting the financial sector. It's my pleasure today to be co-moderating this session together with Christer. Christer not only is a friend, but is an amazing founder and a very important name in the fintech world. He is the founder of Divido, and before that has lots of experience, not only mentoring, but also being in different fintechs. And most importantly, as you will find out quite a bit today, is the author of How Banks Innovate. So Christer, it's wonderful to have you here, and it's been a pleasure to be working with you in the past year. Today, we're going to be talking about how banks innovate, as you know, that's why you're here. And the way that we're going to tackle this question together with Christer is we're going to be dividing it into 3 different panels. And these panels are going to be thinking about different ways in which banks can innovate. So they will range from buying to partnering or building in-house. And then our wonderful speakers are going to be talking to us in these different panels, giving their views. The way that we're going to run this is that after each panel, we're going to have a mini Q&A session where we will talk about that particular topic and gather your questions. And at the end, we will have time for some more questions as well. But before we do all of that exciting stuff, there's even something more exciting, which is that we're going to be starting with a keynote speaker. Our keynote speaker today is an amazing individual who has such a key role in such a key institution in the financial world. Juan Gomez Reino Garrido, who is the CTO at Lloyds Banking Group, and he is going to be talking to us about how banks innovate, and he promised that he's going to do this in a very realistic way. So over to Juan for his keynote, and thank you in advance.
Thank you very much, Pinar. Good morning, afternoon, and evening, everyone. So I love the diversity, and I love being in this environment. I thought I would share a few of my personal nuggets with you. So I would start with some very personal, also almost family considerations. So I'm the only non-PhD in my family. So, and they're all into science. Yeah, H index in the 80s, 2 of them. So very, very proud. And when we get together in Christmas, they don't talk to me. So they have their little science conversations. And the nugget here as to innovation is that some of the conversations that I overhear, I then see happening because they were in research for a very long time. So science is at the core of innovation. The second personal thing is with my 6- and 8-year-old voice. So I was wondering what Facebook was up to. So I have seen Google go into cloud computing and Microsoft as well. And Facebook seems muted, but very far from reality. They've been on to Libra. So what about value exchange? And also into virtual reality. So a moment of realization a few days ago with my 8-year-old was when he asked me, Dad, why don't you do your office things in virtual reality? You have everything there. And when you actually try it now, not a few years ago with the HoloLens and those kind of kits, the latency is so sharp that you have human-like experiences, which gets me into my definition of innovation, which has 4 items. So you can assess any top of mind idea or startup type idea that you have or effort against those 4. And you can let us even know in the chat if that's okay with the moderator. So the first element would be that it needs to be new. So it's like the first time I discovered Uber. So of course taxis were invented, but knowing who the driver is, they can rate you, you can rate them, you can see the little car moving on the street map. That was certainly new. The second one is that it needs to be surprising. So as in, wow, I didn't know operationally that this could come to life. So how to turn ideas and dreams into something that you can make use of. The third element is that it should be useful, but not just as a wizzy thing you consult, you share with your friends, but radically useful, that you would use it tens of times, hundreds of times. And the fourth one is that it needs to apply to a large segment of population or needs or any category that you may come up with. So that is still in my mind, and now I'll translate it into what do we do in our financial services institution, into Lloyd's, and I'll share with you a bit of the secret sauce. So when we think of what's next, we do have like a canonical representation of the enterprise architecture. And at the core, we would have the customer, we would have a transaction repository, and we would have products and services. So on those 3 elements which sit at the core of our business, we overlay this innovation approach, not strictly my personal definition, but we do have a sense of when does value come and when does it come over time horizons. So what is for immediate effect, if you think of the Christensen's innovator's dilemma, and what comes much later in time. So what's an adjacency you wouldn't picture a bank doing, and what is a moonshot? So where will financial institutions, banks, and insurers get to in 5-7 years time plus? So that's part of our secret sauce. That's an internal formal process. We are paid to do that in a way. That's part of my job that I do enjoy greatly. I would like to finish with the why, with the purpose, with why do we innovate? And the first thing that springs to mind is because we don't want to lose the last mile to the customer. So we don't want to become a utility. We want to remain relevant. So that's at the core of why we innovate. The second reason is for scalability. So as the rhythm of innovation accelerates, in order to keep pace in large institutions like our own, which makes it difficult to get things through, you need to mingle, you need to cooperate, you need to have an outside-in view of the world to be able to keep up with it. Most of the answers are not from within. And probably the last reason, and we're not big at this, is to spread our bets, to invest into things that we would see in some time align with our strategy, and we don't know in that exponential function whether it will work or not. So that's my sharing today, Pinar, of innovation. I hope that sets the grounds and the frame for a great panel discussion later. So it's over to you.
Thank you so much, Juan, and thank you for setting the stage in such a systematic way. And this also is a great segue for us to dive into our first panel. And our first panel is about how banks innovate by building. And here I'd love to give the word to Krister to first of all welcome everyone and introduce his panelists for the first panel. Over to you, Krister.
Thank you very much, Pinar. And hey guys, thank you for joining us today. I have two guests joining me for this panel, which is about building and using building as a strategy to innovate. The first one is Manish. He's Global Head of Payments and Receivable at Citi. And the second one is Sabina Filias. Apologies for the pronunciation. She's the CFO at La Fabrique, which is a company created by Crédit Agricole. So what I'd like to do is to give you guys a brief summary of the cases that we have featured from these two banks in the book. And then I'm going to be asking them questions for a couple of minutes. And then I'm going to hand over to Pinar to invite you guys to ask your questions. We're going to be spreading the time even. And we'll dive straight into it. So just to kind of set the scene, the first case is Spring by Citi. So Citi itself needs no introduction. It's one of the biggest banks in the US. It's one of the top 10 in the world. And I was speaking to a Citi executive some time ago, not related to this book. And he said, if you want to make money, you have to move the money, you have to touch the money. So it was perhaps the insight of that combined with the fact that payments for global retailers are becoming increasingly complex that led Citi to build their own full-stack payments processing platform, which is Spring by Citi. It's a simple and safe platform for big retailers to use that operates globally. So that's the case that we'll be diving into a little bit more in a while. The second one, Crédit Agricole, they are the world's largest network of cooperative banks and one of the largest banks in France. And compared to startups, banks innovate very slowly and for good reasons, reputation, security, and so on. However, Crédit Agricole wanted to challenge that by launching a corporate startup studio to build their own startups outside of the bank. So again, two good examples of banks building as a strategy. And we're now going to go into the questions. So any one of you that feels compelled, why did you decide to build anything? Why didn't you just partner or bought something? Anyone can start.
Okay. And maybe we have to go back to what happened 3 years ago at the Crédit Agricole. The bank tried to buy a startup. And the fact is that we made a very good proposal, very high price, but another bank just outpriced the proposal by 50%. And then we lost the deal. And then we just look back and say, that was so much money. Maybe we could rebuild ourselves this company for less money. And that's the very beginning of La Fabrique, which is the startup studio. So we took the money that was supposed to be to buy this startup, which was in the management platform for non-profit organizations. And if we look back 3 years after that, for the same amount, we rebuilt this startup. We made a copycat. And then with what we had left from the money, we built 5 other startups, including a neobank for independent workers. So I think it's a good reason to make yourself that the startups have become so much expensive now. I think the market is just becoming crazy. And on the other side, is that when you buy a startup, it's often very difficult to integrate because the culture of the people is very different from the large group and the startup. And the tech is not usually organized to talk well all together. But when you build your own startups, you can do that with having the good culture that can be a mix between a real startup and a large group. So you can really have your startup work well with the group.
Brilliant, makes sense. Manish?
Yeah, Krista, I think maybe let me start by talking about why we did it. And I think the simple answer to why we did it was exactly what Juan mentioned as the number one reason why, the first reason he gave as to why, innovation needs to be done. In our case, it was about our clients are changing their business model. They're all selling directly online. We've seen this in the course of COVID. and it became rather a reason for them, or the only method for them to actually exist and continue to serve their customers, to sell digitally and directly to consumers. And we felt that we would lose relevance with our clients. We move $4 trillion every day, and that's a lot of money. But if our clients go and start collecting in a different mechanism, we would lose the relevance. So that kind of just said, we have to build a very unique solution. The answer to your question about why build is, as a 200-year institution with like a comprehensive or a proud history of having comprehensive solutions, we don't end up building every day. So to us, or launching a new business line is something that we do, once very rarely. So we went through a comprehensive diligence process of looking at building, we looked at buying, we looked at partnering. And we spoke to a number of our key global clients and asked them what was most relevant to them. And we came to a conclusion that what was relevant to our clients was they wanted a comprehensive global network and capabilities in 100 countries, but they wanted some of the innovation, new ways to process that large-scale fintechs were providing to them today. So we ended up with what I would say is a hybrid model where we took the core stack of city assets. We worked with, very nice, progressive companies. We made investments into companies. We made an investment in a company called Pipro, which is a UK-based company processing alternative payments. We bring them as part of the solution set. And we work with long institutional partnerships like MasterCard and grouped them and made them a core component of the solution. So in summary, it was agility, a need to move fast, which influenced the design, and the actual execution was centered around what was most important to clients. And it was a good mix of city proprietary assets and best-in-class fintech providers.
Brilliant. And actually building on that question, so whilst both of you are featured in the same segment of the book, which is about building, obviously, you have chosen slightly different strategies. So Citi, you guys are collaborating with some existing infrastructure partners, as you mentioned, and then you're building on top of that to create something that's truly unique. And in the case of Crédit Agricole, you are kind of building from scratch. I'm sure you potentially leverage existing technologies as well. Obviously, two different ways of achieving the same objective of building. Would any one of you want to elaborate on why you chose this particular approach as opposed to the other way around, or doing it in a different way?
Actually, we are building startups, which means we're not only building a product, but a complete company. And so it means that if you want it to be a success, you need to find a good combination of several bricks, which are product design, coding, business modeling, legal, compliance. And if you want all this expertise to combine well, to work quickly, the best way for us to do that was to create autonomous startups. And if you want to have an autonomous startups, you need to have a good liberty about what you're doing. And starting from scratch was the best way to have all these people working together on this new venture. But on the other side, I would say we're not always wanting to develop everything from scratch. For example, for our neobank, Blank, we chose to use a core banking system as a service, because if you want to get state-of-the-art technology and if you want to be in the market in a very short time, then you can't rebuild everything from scratch. So I would say that it depends on the startup we want to build. When it's kind of new technology and you don't have anything on the market, we want to rebuild it. But if you have, for example, large technology that have already proven to be more efficient and can help you to launch quite quickly, it's easier for us to partner kind of companies.
Yeah, and Christopher, for us, we just listen to our clients. And what we heard from them was loud and clear. They value what technology companies and fintechs do, which is the maniacal focus on entrepreneurship, the access to new technology and creative ways of looking at existing problems. But at the same point of time, they extremely value what banks bring, which is scale, a global network, capital, financial security, risk management practices. So what they really wanted from us was they wanted us to provide a proprietary solution, but at the same point of time, they wanted to make sure that all the unique things that they see in the market, actually that spirit of entrepreneurship and progress, they actually wanted to be embedded into our solution. So that's why we went down the path, and would have been very easy for us and would have been much easier for me in terms of just going for us to go and buy a company. But that wasn't what we heard our clients tell us that they wanted. They wanted a unique city, branded and proprietary solution, but at the same point of time, all the attributes that fintechs give, they wanted to see embedded in it.
Makes sense. This question is not specifically related to building or the choice of building as a strategy, but it's something that's kept coming up in pretty much every conversation that I've had with the banks featured. It is around talent. How do you compete with, for example, fintechs to attract and retain talent? Because there seems to be quite a lot of buzz in the media and so on to work for, I don't know, Klarna or work for a Vice, a company that recently IPO'd here in London. How do you guys make sure that you attract and retain the best people?
At La Fabrique, I think we have built a kind of new path for entrepreneurship. We're a startup studio. We develop real startups, but we're not attracting the typical entrepreneur eager for pure freedom. Actually, we are attracting more seasoned professional people really aware that building a company is a long, difficult, lonely path, and that being backed by a studio that will provide expertise, support, funding, of course, and a community of other CEOs is a kind of safer way to build a long-lasting company. So I think we're attracting another kind of CEOs, but it's a kind of new proposition. And if you look at the other people within the startups we're attracting, we recently asked to the latest recruit whether their startup being backed by a studio and a large corporate was a pro or a con in their decision to apply. They almost all said that it was really reassuring for them regarding the sustainability of their startups, that it was backed by a large corporate like Crédit Agricole, because you really have to remember that maybe 90% of fintechs just end up bankrupt.
Yeah. Christopher, for us, I mean, first of all, I agree. The war for talent is the real war to fight, and that this is what successful businesses or unsuccessful businesses eventually built upon, is how they manage to navigate that. And we've had a history of hiring people from fintechs, and we've lost a lot of people to fintechs. And I think that traffic of talent coming both ways has been something that we've seen, and it's not a new phenomenon. It's something that we've seen for the past few years. So what we did in the case of Spring by City is, we looked to create this as a startup within a bank. So something that has the capital, the network, the scale, the infrastructure of a large bank, but even if you look at our branding, for Spring by City, as our team made it, it looks like, a fintech. It looks like it's as impressive as your branding. And in terms of, the culture, in terms of the technology assets that we created, in terms of just the, how people dress up and come. And we cut them a lot of slack in terms of how, and give them freedom, the kind of freedom that we would typically expect in a startup, but with the stability as well as all the unique assets that a large bank has, with access to clients and access to infrastructure as they need it, and access to training, etc. So it was trying to build that hybrid. I cannot say that, if I tapped anybody in the street and they had an option to go to a fintech versus coming to a bank, I'd be successful in hiring them. Absolutely not. But there's certain people who are motivated with, again, a hybrid construct of having a startup environment, having the freedom to innovate in an emerging new technology space, but complemented with the security and assets that a large bank has.
Makes sense. Brilliant. So I noticed a lot of questions are coming in on the chat, so I'm going to hand over to Pinar to navigate us through this second portion of the Q&A bit. Over to you, Pinar.
Thank you so much, Christer and Manish and Sabine. It's so exciting to get your insights on the topic of the advantages and disadvantages of building. And we have quite a few interesting questions, so I won't be able to ask them all. However, I'd love to start with a question from Adrian, who asks, whether building outside, and this is directed to Sabine, whether building outside the firm still has integration issues and with different cultures and, having the external units. So could you elaborate a little bit on that issue? Adrian is here pinned. Adrian, would you like to add anything to the question that you posed?
No, I think that's it. Thank you.
Wonderful. Thank you.
Okay, thank you very much for the question. Yeah, integration with the large corporate is quite difficult, but when we create a startup, we want to be certain that being the subsidiary of the Crédit Agricole will be a kind of unfair advantage. We won't create a startup if we're not sure we can leverage some assets from the group, whether it is to have access to the distribution network, which is a very huge asset, or having access to expertise, or having access to some tech, but it doesn't mean because we want that, but it's not always really easy, I have to admit. So that's the real role of the startup studio. We create the startup, but when the startup is created, it has its own team with the CEO, with all the team members. But the role of the studio then changes from building to helping the startup grow. And so we are the interface between the startup, which is a real startup with a startup culture and people coming only from the startup world, and the big corporates. So we're really this interface, helping people talking to each other, translating from these two different languages, and helping the large group get it going quicker, and the startup sometimes being more patient. But that's the whole point of the startup studio, and that's how we could have 5 of our 6 startups now being distributed by the group directly to the client using the retail network.
Wonderful, thank you so much. We have a question from Faraz Ahmed. I'm not sure if he is here. Faraz, are you here? Yes. And would you like to ask your question? Otherwise,
yes. Yes, I'm here. So I'm Faraz, and my question is around scalability. So how do you deal with the scalability issue when you are building a platform or system like this as an organization? And also, how do you support the startups to kind of have this scalability issue resolved? Because this is a big question, which is like, for all of the organizations and normally for the startups as well.
So I think it's a very important question. When you're a large group, you always want to have a perfect product that has to be able to bear thousands and millions of clients. We're not doing that at all. We're building startups, which means that we start with proof of concept, and then we launch a product that is not perfect, but that's on the market. And it's not a problem because at the beginning, we only have a few clients. And then we start distribution, sometimes with the group and the local branches, but we do that step after step. So scalability will come time after time, but not at the very beginning. And I think it's why we could create 6 startups in just 2.5 years. It's because we accepted to start small and then to grow step by step, which is not what large groups usually do.
Manish.
Yeah, Pinar. I was just actually going to agree with what Sabine said. I think our approach is also, when we work with startups, to also look at it as an incremental way. I think it's also important to recognize the challenge. Scalability is one aspect of the challenge. It's also low latency. It's also 24/7. Because these are the things that the economy is currently driving, and this is where startups as well as banks are moving. And banks have a fundamental disadvantage because all of our systems are built for batches. We're not built as a real-time system. So that problem, when we kind of start working with a startup or we kind of bring them into our infrastructure, that problem becomes an even larger problem when you look beyond just scalability, but you look at low latency and you look at always on and resilience. So our approach has been very similar to Sabine. You start small and then you graduate your way up, and then you set up ambitious targets on, TPS, and you say, I'm going to do 1,000 TPS in year 2, et cetera, and then you set up targets as no green zones, and you're going to be 24/7. But you don't do that day one, because if you do that day one, you're setting the startup to fail. and and it's what we call as organ rejection, because you then bring a startup which comes in a very different environment, and you put it into a batch-based mechanism, and you suddenly start seeing that things are not speaking to each other, are not connecting. So again, we do it in steps, in incremental steps, and that is an approach we have seen work.
Fantastic. We have, and thank you, Faraz, also for your question. We have a great question from Andre Porada. Let me see whether he's here to ask his question.
Yeah.
Andre, welcome.
Hello to everyone. My question is the recent phenomena of neobanks appearance. How it changed the classic banks operate, and the classic banks or settled banks are rarely recognized as innovative companies or innovative structure. How do you manage it? How do you change it? And what's the perspective? Thank you.
I'll take a shot at this. So, when we look at neobanks or we look at digital banks, I mean, clearly they have an advantage of bringing technology in from the start. Some of the challenges I talked about, which is, our systems are typically batch-based. We're designed for high value, low volume. And these banks have an advantage that they start with an absolutely different tech stack and a very different set of solutions, unfettered by legacy infrastructure and sometimes unfettered by onerous regulations on some side, and a very conducive regulatory environment. I think, the way we have looked at it is we have learned from these banks. And as we look at launching new products and solutions, we look at the same principles that these banks use in terms of scrum teams and agile structures, in terms of ring fencing teams. And, Sabine talked about a construct that we also have, which is, we call it a deep 10X program, which is, you take ideas and you build around those ideas by having like two CEOs, a tech person, a product person, business person, and then we put a team around it. And in many cases, the execution methodology is often looked at as how neobanks do it. So in some places we compete with them, and in some cases, many of our solutions are also, they're actually a very large client segment for us, because in many cases we support their access to the global network and to clearing systems.
Just maybe to add something, I can't talk on behalf of the Crédit Agricole, but I can talk on behalf of La Fabrique. We launched a neobank focusing on the independent worker, because when we looked at the market in France, we realized that now independent worker is a huge change in the working environment, and the classical banks, they have a difficulty to talk to these people, because the independent worker don't make that much money, and they also need much more than just an account or even loans. They need to have so many more services linked to the account, like a customer relationship manager. They need to have a building. They need to have all the tools to build their clients. And that's why we decided to build Blank, which is our neobank, because we wanted to take a part of this 10% of the whole market that has now been taken by neobanks. And so we built a neobank with your account, your credit card, and the wires. But we also built all these software elements that are helping the independent worker to help them manage their company. And I think that the new way of the neobanks, it's just not only banks, but it's bank plus many services really dedicated to these direct consumers.
Fantastic.
Thank you so much. Thank you.
We'll take one more question, which is again a great question, and one that forces us to be quite realistic. Pravarshan, would you like to ask your question? Okay, just so that we don't lose time, I'll ask instead of Pravarshan. They say that traditional banks have governance and compliance structures, which generally slow and stifle innovation. In this kind of internal environment, which is one of the biggest problems, as we know, in large organizations, how do you attract talent to build really cool things internally? Do you face any dilemma in that, and how do you handle it?
Yeah, I'll go first. First of all, I think, yes, it's true. Banks have risk and governance structures, and that's why banks are more secure. And, if you look at history and you look at statistics in terms of, how the financial system has been kept up over the years, I think, those risk and controls have actually really worked. So if you look at and speak to people in the bank, everybody will value those. And they understand that, and sometimes they kind of become a little bit bureaucratic, but I don't think anybody vastly disagrees with the need to have that. I think our experience has been that, when we speak to, if you look at talent inside the bank and we create like a startup structure and you look at talent to move in, they are creative enough in terms of finding the right balance in terms of executing within a framework that those governance controls provide. But at the same point of time, good talent would always challenge the status quo, because with all the necessary controls, there are always a few others that are redundant that come in and creep in over a period of time. And what we have seen is that, when we get the right people, they actually help us become better by challenging things that are probably right 5 years ago, but are not needed now. And with that, we find the right balance between agility and controls.
Just to add that we're in a regulated environment, whether you're a startup or a bank, and so you have to deal with it. So we decided to integrate compliance natively, just at the very beginning when you're designing your product. Compliance is here. And then makes you able to build products where compliance is here, but it's not a kind of ugly thing you put in the end out on top of your products. When it's really, when at the very beginning you think of compliance, you can have it really integrate nicely into your product. So it's not a problem for us. And when you put this idea of compliance at the very beginning of the culture of your company, it can even become a kind of marketing new way to communicate, saying to your clients, we are serious, we're regulated just the way the other are. So it's not a problem. And I think now that all teams of our startups understand how important it is to be really compliant.
Fantastic. Thank you so much. It's time for us to move to our second panel. And the second panel is going to be about partnering as a way to innovate. I personally want to take Manish and Sabine for their insights, and over to Chris to introduce the second panel.
Thank you very much. So moving on to the next panel, I'd like to invite our next two panelists. It's Gertz. He is the Head of Digital Innovation and Strategy for Digital Banking at Swedbank. And Samir, he is the Managing Director and Head of Consumer, Private, Business Banking and Digital Banking for Asia for Standard Chartered. Thank you guys for taking the time to join us. And like in the previous panel, I'll start by giving the audience a brief background to the case that we have featured in the book as it relates to your particular bank. So the first one, Swedbank, it is one of the largest banks in Sweden and in Northeastern Europe. Around 2010, a group of 6 Swedish banks got together to investigate the potential for a shared mobile payments platform. And 2 years later, they launched Swish. Today, Swish is used by 80% of the Swedish population. This is kind of mind expanding if you think about it. It is arguably therefore one of the most transformational cases featured in the book. The second example is from Standard Chartered. Many of you will be familiar with the bank. It's obviously UK and Asia based. They noticed a growing threat from non-bank players such as Alibaba and Tencent, particularly in the Asia region, and they wanted to do something about it. Their solution was to launch a standalone digital bank in Hong Kong, but with a twist. They did it as a joint venture with strategic corporate partners, such as an online travel agent and one of the biggest mobile phone network providers. They named it MOX, and end of last year, they had over $500 million in deposits. Again, a very successful story. So I'm going to launch into the questions then. So both of you are featured under the section partnering as a strategy, but you've obviously chosen 2 different strategies. Swedbank is working with other banks. Standard Chartered working with non-banks, retailers in this case. Would you mind elaborating a little bit more why you chosen this particular strategy? Anyone can go first. Gertz, do you want
to go first?
Oh yeah, Samir, you do it. You take it.
No, I was saying Gertz, you can go first, but I'm happy to do that either way.
Well, Samir, since you're speaking, you might as well.
All right, I'll do that. Look, I think the reason for us to launch a neobank ourselves was more than the threat from Ant and WeChat. It's HKMA announced a new regime in Hong Kong to give licenses for virtual banks. We never realized that there'll be 8 licenses given out. There's obviously Hong Kong's a very competitive market. We're a large bank in that market, and 8 virtual banks in a small crowded market meant that there was going to be increased competition for us. And traditionally, we've done very well in the affluent segment, haven't done as well in the emerging mass and emerging affluent segment. And that's why the strategy was to build a neobank with obviously partners, and I'll come to that as to why these partners. And the idea was to be more competitive in that segment where we didn't have appropriate market share for the size of the business we have in Hong Kong. And this also gave us an ability to build a technology stack for a bank that would go beyond Hong Kong as well, because it's the licenses for all regulators in Asia is happening. Malaysia has just launched their own license regime. Singapore's awarded a few digital bank licenses as well. China's got a few as well. Korea's got 2. Taiwan's got 2 digital banks as well. So this is a trend that's happening in Asia. So we wanted to be competitive in the markets we operate in. Coming back to the partners, a very simple reason. Hong Kong Telecom and PCCW collectively have 4.5 million customers. And Trip.com is the largest online travel agent in Asia, and they have 1 million customers in Hong Kong. Even with an overlap, we are talking about 5 million customers out of a bankable population of less than 7 million in Hong Kong. And we felt if we were to create financial products that we could seamlessly offer within these partners' ecosystem, we would be able to acquire customers and bank them at significantly lower cost than what we could as a traditional bank in Hong Kong. And that's really the reason why we partnered with them.
Makes sense. And Gertz, you guys decided to partner with your competitors effectively, the other major banks in Sweden. That sounds like a brave, bold move. What were you thinking?
Yeah, what were we thinking? So honestly, we started a bit differently. We started as very traditionally. We started on our own. We started to build a new type of payment service, as we believe that it's a place where innovation should happen. But we very soon realized that we were not be able to break this chicken-egg dilemma on our own. So, and we as well started probably at the part which was not yet ready for disruption. So we started first for B2C payments, and we actually started to use QR codes, and it was before famous China expansion. So we were earlier. However, we did some things not maybe from right end from customer experience point of view, but we decided that we need to pivot our strategy. And we obviously discovered that there is a big market potential, as Sweden is historically the first country in Europe who brought in paper money. So we believe that we should be the first country in Europe who brings it out. So we were looking for ways how to basically digitalize cash. And then we discovered that there is whole big area which is person-to-person payments. But for that, we definitely need the scale. And why we need the scale is a very simple reason. Because if you are bringing something very unique into the market, then maybe scale is a secondary. But if you are bringing a bit incremental innovation, then scale is a game. So person-to-person payments per se are probably not so unique because everybody was transacting before. But to have something which is super simple, super widespread and used by everyone, then we are not okay being alone. So we went for this partnership. And since then we have done other examples in the same area, and we even internally use the name instead of competition, co-petition, which is used in game theory, and it means that you are gaining more if your direct competitor gains as well. So that's a whole new game. Yes, you are right.
Indeed. I guess one of the big challenges for the strategy of partnering is that you have to surrender some degree of control, or you have to at least be open to compromises. How would you guys think about retaining control or managing risks when you're dealing with external parties? Samir, do you want to?
Sure. Less relevant for us, Christopher, because we own 70% of the bank. All of the banking is managed by Standard Chartered. So the governance, the regulations, the building of the technology stack, all of that is managed by Standard Chartered. So there's a little bit less concern around control, but clearly the partner's value is more around the proposition we build for customers and our ability to integrate into their ecosystem to offer these products to these customers and obviously work with them closely, even with their physical outlets as well as all digital assets that they have to be able to offer that our products to their customers. So less of a risk for us from a control point of view.
And Gerd, how do you agree with 5 other banks? It must be a lot of conflicting interests, perhaps.
Yeah, as you can read in the book, it was not exactly walk in the park, but I think that it could be one of the first principles in partnership models that you should start to leave aside concept of controlling. Instead, you should bring in concept of co-creating, because you are in this together to create a new value and then share this newly created value instead of trying to extract value from each other. So I think this is the first thing that to control by basically giving up control on agreeing on something. And here you can read in the book that one of success factors was ability to agree on simple deliverables towards customers. And then if you have this in mind, you have in mind how we are creating something new, then control basically follows naturally.
Brilliant. Makes sense. So again, I see the questions are flooding in here, and I'm going to hand over to Pinar to moderate this second half of the Q&A. Over to you, Pinar.
Thank you so much, Krista. And it's again a fascinating discussion. And before starting with some of the audience questions, I think it's an amazing point here that you make that that you need to see beyond the competition, and in a sense, it brings forward the concept of ecosystems that are now starting to build in finance as well. In mobile payments, in order for the whole thing to work, collaboration is necessary, because if there's no participation, then the whole thing basically falls apart. And we're starting to see this concept of ecosystems becoming a lot more popular, not just as a buzzword, but also in action. And partnerships are a great way to think about building ecosystems. So I thank you both for your comments. And one thing that caught my attention is that while we're talking about partnerships, we're talking about partnerships with entities that are not in finance or entities that are direct competitors. There's also a third category of partnership, which is partnership with Fintechs. Is this something that you guys want to comment on a little bit, your efforts in that area and some of the pros and cons that you see?
Sure, I can start if that's okay. We've partnered actually with more than 40 technology companies, many of them Fintechs, to build our stack. This is obviously beyond the partnerships that we have that own part of the bank with us, which we mentioned earlier. We clearly decided that we wanted to work with best of breed in building microservices for our customers that they specialize in, and they bring that capability. We worked with a brand new core banking solution based out of the UK that delivers a smart contract-based product development capability for the bank that clearly helps us integrate into the microservices that we build with our partners through an API network. It's a modular architecture that most traditional banks like ourselves only dream about having, given the fact that we've got large legacy monolithic systems. So from day one, the strategy was to partner with the Fintechs to build the right architecture for a bank that was easily portable across markets. And obviously it's 100% public cloud hosted bank as well. So, I mean, these partnerships have been invaluable for us. Obviously, challenges in how you deal with more than 40 partners to build a bank. First step in obviously doing this is due diligence, making sure that you're doing an appropriate due diligence, particularly around technology and ICS and data risk. And the next two steps for us is really just how do you manage these relationships? And it's quite critical to have a clear communication and roles and responsibilities defined within the bank, and the strategy clearly laid out that we aren't building this all ourselves and we depend on partners to build this bank. And we've got to manage these relationships as well. And the last is obviously monitor. It's very important because the bank being stable, resilient, and scalable depends on all of these partners doing the same with all the microservices that they deliver with us as well. So we regularly monitor all of the partners. We've got people across the organization, across functions, technology, business, risk, that have partnerships built with their respective partners as well. So it's very important to do that, but the modular structure allows us, Pinar, to actually move away from a fintech as well if you have a problem. And that's why we created that architecture as well.
Fantastic.
Yeah,
Thank you.
I can only agree. I think especially for the bank as we are like systemic, really foundational type of the bank in our home markets. This concept of partnerships with fintechs, it's like a new blessing that is coming. So because the bank, as we are, obviously with a very low risk profile bank for many, we should keep high risks outside, and obviously far-reaching or let's say Horizon 3 or even Horizon 2 innovations per definition are as well one of quite high risk elements. So this partnership model allows us to plug and play and still utilize those innovations, however, keeping a bit those innovation risks outside. And yes, we have as well exploited this direction, and I think lesson learned is as well that it takes obviously quite much on our side to move to this model, but it takes as well quite much on fintech side to move to this model, because obviously there were times when fintech defines that enemy number one is banks. Now they say that friend number one is probably banks. However, they have not, many of them have not pivoted their strategies, and they are basically thinking that partnering with the banks means that they are turning into suppliers to the banks, and which is not the case, because true partnerships means that both parties bring something in to co-create for this new service and then share gained value, not simply I'm selling you technology and you are licensing technology from me. So it takes actually as well time, even if it is a great idea to prepare bank side, but as well to prepare fintech side. And during our experience, I can say that we have embedded into our partnerships with fintechs the same thinking what is in the book around the swish, around this competition. And it turns out that from early days we encourage our fintech partners to turn to our competitors as well. So if we are finding that this fintech is bringing great service, we are actually endorsing this fintech directly to our competitors, because one thing what we definitely understand that it is critical for this fintech company to scale up early as well, because if the service is great but scale is not great, or scale is only with our bank, this service unfortunately could cease to exist, because usually fintech is focused on one or few things, so they really are striving for the scale. So even with this fintech partnership model, we are finding the ways how we are turning competition into competition.
Fantastic. And I believe Till has a question that is along the lines of fintech partnerships. So Till, would you like to unmute yourself and ask your question?
Yeah, two very good questions. Like, one is, how do you actually find the right person to talk to in a bank with usually tens of thousands or hundreds of thousands of employees? And the second question is, how do you overcome sort of the minimum revenue that banks often want to generate from a partnership and that may be hard to generate in the beginning for a fintech? And so how do you convince them it's worth it?
That's a great question.
Actually, in our case, we are paying the fintechs for building the bank with us. So it's less about the bank making money off the fintechs. It's more about how do we collaborate with the fintechs to pay them the appropriate price for the services that they deliver for the bank. So a little bit different in our case.
Yeah, in our case, definitely it is very much dependent on people whom we have in our innovation team, who are knowing or sensing what will play out and what will not play out. So yes, internal anchoring, internal finding right stakeholders early on is very critical. And then the second thing, what is critical is actually together with this fintech, define this not maybe even minimum viable product, but I've heard somewhere it's better to call it minimum lovable service. So not MVP, but MLS. And if you are defining this MLS, and it really makes sense for the stakeholders, and it basically opens the door. And example, I would say one of the most successful examples we have is a thing called subscription management. So this is a thing which theoretically we can definitely develop ourselves in-house. It's not a rocket science. However, we found a fintech for whom it is priority number one. So they are just focused on that. They are obsessed with it. They are obsessed with making customer journey within the subscription management or subscription handling the best in class. So this minimum lovable service was very well perceived by our internal stakeholders as users themselves. So it just makes sense for them. So, and then it opened obviously many doors. And now this fintech company is, yes, working with our direct competitors, and one of investors since this year is Visa International in this company. So and we were the first ones, and we have discovered this fintech in accelerator by our competitors. So it's even started like that. So you have to be open-minded and look for hints and tips across, even with your competitors.
Thank you.
Thank you both. What I'm also hearing from both your comments is that in order to partner, you need to be not just ready in terms of your mindset, being collaborative, co-creating, but your IT infrastructure needs to be ready for it, for integration, as well as your organizational structure and the way that you organize yourselves internally, just so that the fintechs actually, or whoever partner you're talking to, has the right people to talk to, and that they just don't go around, making circles and not getting anywhere. Very valuable comments. The last question will be from Daniel. Would you like to unmute yourself, Daniel?
Yeah, sure. So I found the story about Swish fascinating, and the success, reaching 80% of the Swedish population, and using the ecosystem, actually working together with your competitors. I just wonder, when I hear something that's successful, I would like to make it even more successful. And in Sweden, I guess, it's difficult to be more successful. So the only option would be to go international. And how can that success be replicated, in other countries where Swedbank doesn't have a presence, because there you don't have the stepping stone that you are not already there and can work together with your competitors. Are there any ways of making it an international success or scaling it up even further?
Very easy it would be if other countries would adapt to Swedish krona, then it's super easy, because it is built around exactly Swedish krona payments, and it's actually even partnership with central bank who is running those payments, so it's even more sophisticated thing. But I think one thing which could be desired more is built-in ambition to scale to other countries, I think, for the Swish. But there are banks who are very local in this setup, so they are maybe not so much interested of going it out. So it adds some complexity. Yeah.
Absolutely, and you know, a lot of times these ecosystems have such strong local elements that not just the government participating, but also a lot of the local banks. So it's almost sometimes worth it to recreate something locally rather than trying to grow it. And a lot of fintechs actually face this as well, because what they are offering is so dependent on local regulations that it's easier for a local competitor to do it rather than them trying to go into new countries. I believe we're coming to the end of this panel, and we've got one more panel to go. So I'll turn it over to Krista to introduce the last panel. And thank you, Gertz and Samir, for your wonderful comments.
Thank you very much, Pinar. So yes, moving on to the final panel, which is talking about buying/investing. We have two guests again. You know the drill by now. Is Jay. He's the general partner at Propel Ventures, which is an offshoot from BBVA. We also have Martha. She's the managing director and head of North America receivables at JP Morgan. As for the previous panels, I'll start by giving a short summary of the case that the book is featuring on, and then we'll dive into the questions. So a lot of you will know that BBVA is one of the biggest banks in Spain, but is also the largest bank in Mexico, and they have loads of operations across South America. In 2012, they launched BBVA Venture, a very traditional corporate VC fund, but in 2016, they spun that out and created an independent venture capital fund, and they named it Propel Ventures. In this short period of time, they've already backed a number of firms that have gone on to become unicorns and seen several successful exits. The second case is JP Morgan, and they don't need any introduction. They are the largest bank in the US. And one of the sectors that's been growing a lot in the US is healthcare for many, many years. And one thing that's become increasingly complex in that space is payments, because there's so many stakeholders involved, everything from the patient to the hospital to the insurance companies and so on. So spotting an opportunity to make this easier, JP Morgan saw an opportunity to address this, either by building or by partnering. But in 2019, they decided to acquire Instamed, a company that specializes in healthcare payments. So I think you hopefully now see the connection here in terms of why these two are here today to help us talk about buying as a strategy. So panelists, welcome. First question, you are obviously both featured under the same category, but we are showcasing two different ways of approaching it as a VC versus acquiring. Jay, would you like to kick off and talk us through why BBVA or why Propel Ventures has chosen this particular strategy as opposed to buying off the balance sheet?
Yeah, sounds good. I think maybe stepping back just a minute on why even venturing makes sense. I think it goes, the basic premise for why to invest starts with the belief that these startups are doing something meaningful, that they are often very good at understanding early customer trends. They're very good at building product. They're customer focused. In studying them is also very hard to do because they are private companies. They have websites that are usually ambitious, not necessarily exactly what they're quite doing right now. And even oftentimes large institutions will hire consultants to understand market trends and the direction of where things are going. But these startups are really hard to get information on. Even McKinsey doesn't have that information. So believing that they are good indicators of where the direction of the industry is going, but also very hard to get an understanding of, in investment is one of the only ways really to get under the covers and have the right conversations. Oftentimes as large institutions, we talk to these companies, but mostly as potential vendor relationships, and you're talking to the salespeople. You're not necessarily talking to the leaders of the organization who are driving the direction or the board. And as an investor, you do get that access. Understanding the best companies out there have choices on who they want to take for investors. It's really competitive to get the best companies. And of course, you want the best companies because they are going to provide the best intelligence. And in order to get the best companies, access to those companies, you want to design a venture fund or a venture product for them that best meets their needs. And that really requires to be aligned with that. So I sit in Silicon Valley, and I have so many competitors in my business, the ones you've heard of, Sequoia and Andreessen, that are really, really good brands. They're really good at their business, and competing with from within a organization that I think you guys all understand, because many of you come from within financial institutions, which I've been there myself for many, many years. It's sometimes hard to get the organization to do something that's risky. And so designing an organization as an external fund and that's also aligned with the startups, with us putting our own money in, we're risking our own capital in addition to our LP's capital, is really one of the best ways to get access to the best companies.
Makes sense. And Martha, why acquire outright rather than just investing?
Yeah, I think they're quite different strategies. You're right, Christopher, about that. I think that there are lots of different ways that our institution and many institutions that have been on the panels today want to invest for different results. In the case of the InstaMed acquisition, here is a part of the US economy, and as someone said earlier, really following the payment and looking at what clients are looking for from banks. This is a very key part of the US economy, and it was something that we felt was not only something we wanted to invest in, but we wanted to grow market share. And it's a complex space. Many of the panels today talked about needing to pull together many different types of expertise or platforms or pieces of tech in order to achieve what they want to achieve. We felt that if we could find a high quality company that had a multifunctional platform that could address our payment needs and our payment market share interests, we might be better off acquiring the entire company rather than renting or investing in pieces individually.
That makes sense. In terms of the pros and the cons, so maybe Jay, obviously BBVA Ventures was investing from his balance sheet. Now it's doing it through you and Propel Ventures. What are the pros and the cons? What have you lost along the way and what have you gained? You kind of alluded to some of it, but just to kind of tease that out a bit more.
Sure. And even comparing to the buy versus just invest, I think the idea behind that is more we're getting a basket of investments, or a basket of sort of a radar screen of a bunch of different things that's going on. And obviously that intelligence is probably the best byproduct of that. And of course having the access to the best companies gives you the best insight. But I think what you might lose there is the more direct connection to the organization, where involved in the diligence, involved in the decision making with the investment, you involve the business unit, and there's a business unit sponsor that says, yes, if you guys are going to invest in this thing, we're also going to have a very deep partnership with them, which is oftentimes what the reason that large organizations are interested in investing, because they want that partnership, but then also the startups are very interested in that. So like I said before, they have lots of options for who to take for it as investment dollars. But when a strategic organization can come to the table, not only with dollars for investment, but also vendor dollars, that can be sometimes a very substantial opportunity. However, that oftentimes comes with challenges, because financial institutions in particular come with a very tough procurement cycle. Buying cycle is really long, and startups sometimes need to move things a little bit faster. They have limited life, and that requires sales to happen. So in order to balance that, that's why we try to make ourselves a bit more agnostic, where we're trying to just do the best thing for the company. And hopefully if BBVA wants to be a customer because that's the right thing, then we'll try to help push them in that direction. But then also if it doesn't make sense, we'll try to help with, of course, with other customers.
Makes sense. And Martha, you kind of touched on this as well. Is there anything you want to add in terms of the benefits or the disadvantages buying outright versus just investing?
Yeah, I think, clearly one of the, let's say one of the things that you lose is you do have the pace of business or the flexibility and the agility of the company that you bought. is going to change. I mean, there's no doubt about it that both, even the businesses that JP Morgan integrates or works with related to this part of our company is going to have to go through change, just as Instamed, or the target company that we acquired, has to go through change. And that's very important to manage, because I think you can lose, momentum. You can lose focus, commercial focus, and it's very important that those are maintained. Otherwise, the minute that you stop both of those things, the value that you're creating by acquiring that company is certainly could be challenged. I'd say the benefit, just to add to my comments before, is also around time to market. We'll get into that a little bit later, but that was a very large part of our decision to make the type of investment that we made.
Yeah, brilliant. I'm mindful of time and the schedule, and so I'm going to hand over to Pinar to walk us through the Q&A from the audience. Over to you, Pinar.
Absolutely. Thank you so much, both, and thank you, Krister. And we still would like more questions for this particular panel, but in the meantime, let me get started. There's a question which actually applies to all panels, but I would love to start with your views as well. The innovations that open banking bring are actually quite interesting to think about. And these might be important for the case of partnerships, but they also allow institutions to actually work together much more easily and integrate much more easily. So can you tell us a little bit about integration, and then whether open banking is something that is in your world as something important?
So maybe I'll make a quick comment about that. I will say that is one of the very valuable byproducts of having done the integration of pulling in Instamed. We were able and needed to go extremely deep into some of our core systems to be able to set up an open banking architecture, if you will, to make sure that the integration was done as quickly as possible, but as safely as possible. And in this regard, I think because of the toolkits that are now available to all institutions around isolation of services, the ability to stand up APIs very quickly, it allowed us to actually integrate and to start to pass payments between our organizations within less than a half of a year. And that would have been unheard of, I think, for all of our institutions 3 to 4 to 5 years ago, where these toolkits were not available. So in general, I think it's good news for everyone that the toolkits are there. It's a matter of configuration and design, and coming up with the right delivery method.
I'd agree, and I think the person that benefits here is the customer. On the startup side of things, of course, they've been able to leverage those APIs to get access to data that then oftentimes is driving some sort of service that's much more personalized than I think we've been able to do in the past. Just because oftentimes they're pulling information from multiple institutions, recognizing that consumers oftentimes have multiple relationships, which sometimes in a silo, when you just have one piece of the relationship in a financial institution, you don't necessarily understand the bigger picture. So while there's been companies that have been trying to do this for a long time, they've been sort of hacking it, meaning taking username and passwords, and sometimes that breaks, and so the service has oftentimes been clunky. But now that there's much more reliable services out there, these companies have scaled. I think you saw what Visa had intended to do with the acquisition of Plaid, which didn't work, which I think in the end may end up being a good thing for consumers, just because that company will survive and continue to innovate. And that's just one of the small pieces of open banking. There's also just the account opening, which has opened up a big business for many banks that have decided to be a service provider even to the startup ecosystem by enabling them to be the bank as a service behind the startups.
Fantastic. So a couple of interesting points maybe for us to touch upon as well, and I'm sure that Krister would also love to contribute with more questions, is the issue of integration, especially when IT systems are so difficult to integrate due to legacy or disparate data. Can you tell us a little bit about the process of integration and maybe some of the do's and don'ts in that process?
Happy to do that. So the do's here, I think, are setting up accountability very deeply across all the functional areas that are going to touch the business that you're integrating. I think some of the panelists earlier talked about the necessity of having risk and compliance and other security teams involved. I couldn't agree more. But bringing them in early and giving them accountability for delivery, just as you would an operational or tech team, is important, because all of those things need to come together so that you can go into production. And I think if there were one, do better, I think on the part of JP Morgan, which is in the book, is to make sure that those are very clearly delineated and brought in, again, in a very early part of the integration. I think the other thing that we've learned is, and this is part of due diligence, and I would say it applies whether you are going to buy or invest in a company or partner, as some of the other models and ideas were discussed today, and that is due diligence in terms of technology. Is there a tech stack narrative around how the companies could be compatible, or how difficult or complex will some of those core processes be, so that you know what you're getting into when you want to start to operate or co-manage your businesses together. And I do think that you can go in eyes wide open, but you will always find the small things that can keep you from completing your integration. To that end, I would recommend any of the teams that are doing this kind of work to make sure that you've got project leaders that are tech savvy and operational savvy, not just project delivery savvy. That allows for faster identification of new ideas or a new approach to how to integrate, a particular element of the effort. And it's very, very important that that particular assessment is something that is widely circulated and communicated across all the stakeholders involved in the integration. So it's about going deep and going deep early. It's about having expertise within your program delivery groups that have a technology and operational background that can help you assess and identify things quickly. And then obviously it's, common reviews and a common and transparent way with which your deadlines and your delivery occurs.
I have a general question, if you don't mind to sort of put in here. What's your kind of framework or methodology for scanning the market and to sort of keep tabs on what's happening and identify potential opportunities for you guys to either acquire or to invest? Do you have anything you can share there in terms of approach? Maybe Jay first.
Sure. We founders are all over the world now. In the fintech market, as we all know, has exploded. So we try to get signal from the market by lots of different methods. The best method for this is having a good network of founders, because founders are like a little bit of a club themselves. They need each other to help solve problems. Something that didn't work at one startup, someone else can learn from, and the good ones, of course, band together. So we have a network of startups of ourselves, the ones we've invested in, that we of course look for opportunities where they may be helping their friends. We look for other investors around the world to provide signal. They're the ones that are best. I'm never going to know the ins and outs of the Brazilian banking market, but I do have some very good friends that are in venture funds down there that are much closer. Same thing with most other countries that we're interested in. It's our full-time job to be doing that. We try to do marketing just like any other company would. So that the startups can find us through social media, through conferences, through being out there on its Twitter and just being out in the market. And so understanding as they're looking for investors that are understanding fintech and at their stage of business that they find us. Of course, we only are investing in a very, very, very small portion of the ones that we end up seeing, but it's also about being very respectful to the ones that we have to say no to. so that they even say, okay, I understand that these guys were not a good fit for Propel, but you know what? Maybe I got some good feedback from them, and maybe my friend is a better fit for them, and so that hopefully they it leaves a good impression, and we're just generally, we also try to have that pay it forward mentality of trying to do as much as we can for the ones even that we're not investing in.
And you, Martha, then, so why Instamat, or why healthcare payments? There must be hundreds of other ideas out there.
I think there's a diversity of ideas, and there's lots of ways to grow, right? And I think we've heard a lot of really good examples today. The problem we were trying to solve is the fact that the healthcare market in the US is quite large. And it was really a matter of we wanted to grow our payments business, and it was a market share opportunity. We also saw many of the same consumer desires and needs for digital services because of the size of our consumer bank and some of the feedback that we were getting from that client base. It was clear to us that healthcare was ripe for digitization. And so as we started to look at opportunities, this particular company represented an opportunity to tap both markets, consumer healthcare and also the rest of the healthcare delivery market. And so that was fairly unique. And we realized that we were going to have a very long cycle if we wanted to try to build ourselves, or as I mentioned before, partner with multiple parts of or experts within the field. And this represented a more unique opportunity to look full scale end to end at healthcare payments, which is, as I said, extremely large part of the US market. That being said, it certainly helps that we had a diversity of investor activity and innovation across the firm that could help us do our due diligence. So pulling in our retail teams, pulling in our payment technology teams, so that we knew that we were getting a very future-orientated set of services that met the needs of both ourselves and Instamed to grow our businesses.
Brilliant. Pinar, any final questions from you?
This has been wonderful. Thank you so much. I think I learned a lot, and I don't have any final questions.
Perfect. Well,
Great.
in that case, we'll thank the panel. And Pinar, I believe you and I are going to leave some concluding remarks.
Exactly, yes. Thank you so much, Martha and Jay. And thank you, Christer, for not only writing the amazing book, but also for leading these panels. The questions of build versus buy versus partner are interesting. And as we've seen from the panels, they are dependent on a lot of the priorities that the organizations might have. Whether it's a core service that needs to be revised or rebuilt, whether speed is of matter, and whether innovation is so fast that building something inside actually ends up being not fast enough, or maybe it's not possible to update quickly enough. There are many different considerations, and we've touched upon several of them. And we've also seen that whether it's to build or whether it's to buy or to partner, there are also different versions of that same question. You can partner not just with your competitors or with startups, but you can also partner with critical players from other industries in order to integrate industries even more. And when we think about the way that the regulatory environment is moving, first with open banking becoming prominent around the world, going towards open finance, and finally open data, which will strengthen that cross-industry integration that Martha has mentioned. I think that these considerations need to be taken in a cross-industry context. So thank you for all the wonderful panelists for bringing your views, and they were highly complimentary. Thank you, Christer, for choosing them, and I'll let you have the final words before we give it over to Viola.
Thank you very much, Pinar. And I echo everything what you just said there. And I think what was so remarkable for me going on this journey, capturing these stories, is just how many stories there are. I think banks get a lot of bad rep for perhaps not being very innovative, but the last 12 months, I've seen nothing or heard nothing but innovation. So I'm incredibly bullish about the banks. Perhaps they start a bit slower, perhaps they move a bit slower, but when they get going, they have that momentum, they have that brand awareness, they have that reach. they can really have will have a major role to play going forward. Without a shadow of a doubt. I know some people are saying that fintechs will replace them and this and that, but there's a reason these banks, many of the ones we've met today, they've been around for 50 years, 100 years, 150 years. This is not the first time they've fended off competition. It's not the first time they've dealt with a recession. They're in business because they're really, really good at what they do. So I'm only humbled and impressed and excited about the stories that I've had the opportunity to learn about. And yeah, I'd just like to say thanks again for the panelists and for our keynote speaker for making the time to join us today. And I continue to keep an eye on you guys, what you're getting up to. So thanks for that.
Yeah, we will not be letting you go. Thank you so much, Krister. Over to Viela.
Thank you, and I just lots of thank yous, and I just want to say thank you from my side to Pinar for leading on this conversation, and Krister for joining us today as well, and all the panelists, and obviously thank you alumni who joined us from all over the world for today's session, and seeing all the questions coming in the chat was so great, and obviously thank you for those who came on the screen to ask the questions and take part in the discussion. It's just so wonderful to see how engaged our alumni community is. So thank you so much to all of you. Also, Charlotte Courtney, who put together this event and made sure it all ran smoothly, and Jill Britnell, who supported Charlotte. So both of them are from the Alumni Relations team. So many thanks to two of them. We do want to continue doing these sessions, and we want to ensure that they are in the right format, at the right time, on the right topic. And we will be sending you a very short survey, and I would really appreciate if you could take 2 minutes of your time to give us feedback on today's session. Let us know what else we can do moving forward. It will be very appreciated. And obviously with summer already here, although looking outside, I'm not sure about that. We will be taking a short break from our OBA Connect Online events until September. We will use this time to evaluate what we've done in the past year. We want to hear from you, how else we can engage with you once the world is opening up, but we've seen a massive opportunity to reach out to alumni who wouldn't have come to our events in person otherwise. So we want to continue with these. We just want to see what kind of format they could take moving forward. So have a wonderful summer. Stay safe, and hopefully see you again in September, and hopefully in person at some point. So wonderful day, wonderful evening, morning to everybody. And once again, thank you, Pinar. Thank you, Krister, and all the panelists. Thank you so much, and take care.